Hello and good morning, listeners. Welcome back to Almus Market Mornings with Jayaram Krishnamurthy, your daily dose of financial market updates. Now, folks, as mentioned in the previous commentary by JK, the dollar rally did hit a small bump with the dollar index correcting a little, a tame PPI update, and the yields pulling off their highs. Participants now await the US inflation update along with the UK inflation update. Now, sterling had its own woes with the mounting pressure through the rising borrowing costs. On the domestic front, we see the reshuffling of portfolios post the retirement of Mr. Patra on the RBI's MPC committee. DK, what do you read out of these particular developments and what should we be expecting out of financial markets?
Morning, Shikhar. Good morning, all. Uh, I think there is a lot of focus on how the rupee behaves in the coming days in view of certain reports emerging that RBI will be not intervening so consistently or so severely like earlier. Um, this is some media that reported, not really quoting any RBI official. However, we are seeing some, freer movement in the currency. Since Friday's closing, we have already seen nearly 1% drop in the INR, although we have seen the dollar also rise after non-farm payrolls report. But while the dollar has retraced, rupee has remained on the weaker side, uh, perhaps more inclined to correct its overvaluation. We did see all-time low of 86.64 yesterday. There was some intervention, but it seemed to be sporadic and not holding rate at any particular level. And so there is a general perception that central bank will be intervening only to avoid excess volatility and will not stifle the rate against the market pressures. This means, if this really plays out this way, then we should be prepared for more volatility on both sides. Rupee could weaken more if the dollar strengthens more, and rupee could see some strength also if the dollar retraces. So, corporates, I think, from a stage of relaxed, kind of complacency that was setting in because RBI was controlling the rupee movement. Now that is not there anymore. We need to be more alert for managing our risk. That is what is emerging from these, developments. Yesterday in global markets, of course, we did importantly, we had this PPI report, the producer price index on the US, which was quite weak. The core inflation rate 0%, no increase at all on a month-on-month basis versus forecast of 0.3%. And the overall index was also up only 0.2% below 0.3% forecast, for the headline. And year on year was 3.3% versus 3.5%. So overall, there was a cooling of at least the wholesale prices in the US, and that was a good news for the bond market. Definitely, bonds rallied after that. 10-year dropped to near 4.7%. But then these factors are not really having a sustained influence on the market because now market is looking beyond these numbers. And the Trump administration taking over and what is likely to be the policy pronouncements after he's taking over on Jan 20th, that will be seen. And beyond that, market will also be focused on how the deficits of US is going to play out, because there's also a news which says that the first 3 months of this fiscal, US has already seen a rise of over 700 billion in their deficit. So at this rate, where their debt will go and what is it that the US government will do to curb these deficits and debt. So these are bigger questions that the market is trying to find an answer for or wait for authorities to say something. So that is why these day-to-day data are not really having a lasting impact. If you look at it, Euro USD is back at the level where it was before the non-farm, big beat in the non-farm payroll report that was announced on Friday. So really, we are seeing some sort of a consolidation and waiting approach as far as the dollar is concerned, despite calls for dollar to rally much more and all that. So there can be scope for more retracement in the dollar in the couple of sessions ahead in this week, but one cannot be really sure about the direction until we get the official announcements of whatever the policies that Trump government is going to pursue. So that is big thing. Today we also have the consumer price inflation data from US, where again expectation is for down move in the core inflation month on month to 0.2%. But on the year-on-year basis, it is likely to increase to 2.9%. Kind of mixed data that is expected. But as I said earlier, the data may not have much of a lasting impact. Market also could be looking at the earnings data from banks, which kicks off today, big banks, and then it will be followed by the big seven on the tech sector next week. So a lot to digest for the markets, and in the context of rising yields and perhaps 10-year expected to touch even 5%. All this, this is not a situation where stocks are finding it easy to make gains. There are no real new factors for them to make gains as well. So we have seen euro recover to 1.03. Apart from the fact that the yields came off and the PPI was weaker, we also had a statement from one of the ECB members who said that don't think we can lower rates too quickly, and the core inflation is still closer to 3% than to 2%. So that also supported the euro to some extent. And in case of Japan, an official statement is that options are open as far as the January meeting is concerned. Although yen still trades above 158, but market is not sure. It's still a possibility that Japan springs a surprise, but I think they are still studying how the Trump policies are going to come about. So that is one big uncertainty that they are dealing with. Otherwise, we would have been fairly sure that there would have been a hike by Japan in the coming meeting in January. So a lot of we have seen a lot of trendy moves till end of December. Normally in January, also by first or second week, we do get from second week definitely we do get a directional move. But then this year, that will have to await for a couple of weeks more because of the key event of shift of power from the Democrats to the Republicans, and so that's the big thing that we are looking at. And beyond that, as I said, the mounting deficit and debt problem of the US, how that will be handled, whether it has a bigger implication for the dollar or not. These are the things that we will be studying in the days ahead. So we take days events, with much less implications for the dollar for the time being. Thank you.
Okay, JK. And yes, indeed, folks, we need to wait a couple of more weeks before we get into any sort of directional activity for the FX markets. Till then, as expected, we can see both side volatility with the new government setting in. On the updates or the summarizing front, we can see that some retracement can be possible, but the clarity on the trend will be only available post the announcement and setting of the new government. The earnings session is already in play from the banking side as well as the Magnificent Seven. The euro saw some sort of retracement, and the ECB official statement around the pace of rate cuts was also, one of the contributors for this kind of a move. The overall cooling of the wholesale prices on the US economy was taken as a good news, and some sort of retracement in the yields was also observed. Now, the change or the domestic front, the change in the FX stance can be also be observed slightly with a freer currency movement in the past week, but can this volatility sustain, or would this volatility sustain on both sides, is something that we'll continue to watch over the coming days. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for joining.